CNBC is out with its latest Fed survey. This is the Fed kicks off a two-day policy meeting. Steve Leisman joins us with the takeaways from that survey. Steve.
Hey, David, it's some interesting results. The probability of a recession next year dropping below 50%. That's for the first time in a year as respondents to the survey begin to think about the real chance of a soft landing for the U.S. economy. So how are stocks priced? If there is a soft landing, well, overpriced, according to this group. 7% say significantly so. 40% say somewhat. Just, 30% there believe that they are correctly priced, and 20% see them as underpriced. So this group's still believing that stocks are overpriced relative to a soft landing scenario, and that's why when we ask them where the S&P is going to end the year, not much change from where we are now. In fact, down just a bit before they get to about a 5% or a 4.6% increase next year, with the S&P going to 47.67. But there is somewhat less risk now in stocks. We look at the probability of a 10% increase or decrease to get a sense of how much risk is out there, and that risk is narrowed. You can see there it had been minus 15, the difference between the two, and now it's minus 8. So a little bit more sense that risks are better balanced. A big part of why recession probability has come down is because of the perception that there's less systemic risk in the financial system. 72% seeing it as above normal back in March. That's in the wake of the Silicon Valley Bank failure. That fell in June, and it's fallen again now, below 50%. Still high, though. What might be holding back respondents from being more bullish on stocks is that even while risks have come down, they remain elevated. Recession risks down below 50%, but still double the average. And the financial risk still seen as above normal. Among those risks, as you guys know, how high does the Fed go? Does it create a recession? The survey says just one more hike, but most Fed officials see two, and some see more than that. So we got to solve that problem, guys.